Welcome back to the Neuro Finance Masterclass. This is day 63 of our 365 Days to Financial Freedom series, and today's theme is the bond market and the risk-free rate. So yesterday we explored a truly undeniable force, right? We talked about how the Fed essentially controls the gravity of the entire market just by changing interest rates. We saw how those tweaks pull the levers on literally everything, from corporate borrowing to your everyday mortgages. But today we are taking that knowledge a massive step further. In this explainer, we're going completely behind the scenes to uncover the hidden giant of global finance.
Now, I really want you to think about this central mystery for a moment. When the Fed raises rates, when they turn up that financial gravity, and the billionaire whales panic and sell off billions of dollars in stocks, where does all that massive capital actually go? I mean, institutional money of that magnitude doesn't just sit idle in a standard checking account earning 0%. No way. It has to go somewhere incredibly safe, and it has to go somewhere big enough to actually absorb it all.
To solve this mystery, here is our syllabus for today. We'll be covering 1. The market's bigger brother. 2. What is a bond? 3. The risk-free rate. 4. The great capital migration. And finally, 5. The ultimate shock absorber.
All right, Section 1. The market's bigger brother. This is the quietest yet absolutely most powerful arena out there. While stocks get all the flashy headlines, when the whales sell, their capital flows directly into the absolute biggest financial arena on Earth, the bond market.
Which brings us right into Section 2. What is a bond? This is where you transition from being just an investor to actually acting as the bank.
So a bond is simply a legally binding promise from a borrower to repay loaned cash on a specific date, plus a guaranteed percentage of annual interest. Look, when you buy a U.S. Treasury bond, you are literally loaning your hard-earned cash to the United States government. In return, they give you an ironclad promise to pay you back your original money with annual interest along the way. You're no longer just crossing your fingers hoping a company's new product does well. You have fundamentally changed your role. You are now acting as the bank for a global superpower.
This really highlights the stark contrast between these two asset classes. See, when you buy a stock, you're buying fractional ownership in a business. If the business has a bad year or the CEO makes a huge mistake, your returns are highly volatile. You are sharing the risk. But with Treasury bonds, you're acting as the bank for a guaranteed return. You don't care about quarterly earnings calls. You literally only care that the borrower pays their debt. Moving to Section 3, the risk-free rate. This is the bedrock foundation of Wall Street math.
Let's say the yield on a Treasury bond is 5%. Because a superpower government like the United States can theoretically always print more money to pay its debts, U.S. Treasury bonds are considered the absolute safest investment on the planet. This guaranteed 5% is known as the risk-free rate. Just think about the profound psychology there for a second. If the government guarantees you a 5% return, completely risk-free, why on earth would you risk your billions in a highly volatile tech stock that might only give you a 6% return, but comes with the very real risk of losing half your money? You wouldn't. Nobody would. That mathematical reality right there is what shifts the tectonic plates of global wealth.
That takes us to Section 4, the great capital migration. This is the secret mechanism behind market crashes.
Walk through this exact cause and effect chain reaction with me. Step 1. The Fed raises interest rates, turning up the financial gravity. Step 2. Because rates go up, newly issued bond yields also go up to match them. Step 3. Suddenly, billionaire whales and massive institutions see they can get a guaranteed, safe 5% or 6% return just by holding government paper. So they aggressively sell their risky stocks to capture that guaranteed yield. And step 4, stock prices bleed. This massive, coordinated migration of capital out of the risky stock market and straight into the safe bond market is exactly what causes stock market crashes. The money didn't vanish into thin air. It migrated.
And finally, Section 5, the ultimate shock absorber. It's time to talk about building your financial mansion. So how do we take this Wall Street mechanism and build enduring personal wealth? Well, we have to return to the mindset of the architect, a concept we established back on day 47. Listen, the stock market is just one room in your financial mansion. It's the room where growth happens, sure, but it is not the whole house. The bond market is the foundation. As an architect of your own wealth, you don't just hold volatile stocks and cross your fingers hoping for the best. You use bonds as the ultimate shock absorber. When stocks crash and the broader economy inevitably slips into recession, bonds provide stable, guaranteed cash flow. That predictability is absolutely crucial. It's what protects your neuro fitness. It keeps you from panicking because you know your foundation is paying you out like clockwork.
Which leaves us with his ultimate provocative question. Is your portfolio built to withstand the whale's next migration? Think about it. If you only own risky assets, you are going to be caught in the undertow the next time the Fed adjusts the gravity. But if you truly understand this hidden giant of the bond market, you can observe exactly where the whales are parking their trillions, and you can learn to park right alongside them. That is how you survive the crashes, and ultimately, how you build true, unshakable financial freedom. Thank you so much for joining us for today's Explainer, and we will see you right back here in the next masterclass.